Hello, everybody. This is Daniel Wynn. Welcome to the Daniel Wynn Podcast, where we talk about real estate investing, private lending, and alternative ways of earning money and side hustles. Today, I want to talk about navigating uncertainty. I want to share a transaction that looked like it was dead, and we were able to save it by using a little creative juices and a little bit of good luck. First thing I want to talk about is what's going on in the news right now, or in the real estate investment industry. What are the trends? Interest rates are still high. Interest rates are high, which means that some buyers are leery of making the commitment with the higher rates, which means higher mortgage payments. And it's also slowing down sales. I don't know what it's like in your area, but in the Midwest, Chicago specifically, sales under 400,000 still seem to be moving pretty well because people can absorb the higher interest rates. When you get above that, sales seem to be slowing because the higher mortgage payment is making it much more challenging for people to make that commitment. And I think that's been the trend for the last 6 months or so, and will continue to be the trend. So where are the opportunities for the rest of the year? I believe the opportunities are going to be in areas where the inventory is going up, where sellers are having to lower their prices, where sellers are being motivated. That's when you can get the best deals. As we all know, and many of us agree, you make the money when you buy, not when you sell. So our philosophy when we're buying real estate is buying it at the right price. Then we assure ourselves a win when we get rid of the property or dispose of the property. So interest rates, buyer sentiment, and inventory levels is having a big impact across the nation. So how do you take advantage of it? Well, if you're an experienced investor, you've been through many of these cycles, and you know that it's just another cycle. So you have to slow down and be patient and wait for the right deals. You don't have to buy, and we don't have to buy every deal that we see. As a matter of fact, you have to pass on a lot of deals. One of the most powerful things that we can say is no, right? People call you up with their deals, they're trying to offload them to you. And if you don't like the deal, you don't like the numbers, you don't like the look of the property, just say no and move on and wait for the right deal to come in to your view so you can decide and add that to your portfolio, flip it, wholesale it, whatever you're going to do. Now I want to tell you about how we saved a deal that had unforeseen liens and city mortgages. Oftentimes when you get a lead to buy a property, you get excited talking to the person that wants to sell it, right? They start telling you about the property, what they're willing to maybe accept or not accept, the problems that they're dealing with, tenants, termites, whatever. And you get excited about the property and you want to take it down. You want to put this, you want to add this to your portfolio. You want to buy this property. And it's really important that we had found an off-market deal and we liked it and we got all excited. The numbers looked good. We were motivated. And then we found out when we ordered the title policy that there was an old mortgage that the borrower had more or less forgot to tell us about. And they were the heirs to the property. So they inherited the property. They didn't know anything about this mortgage. And there's this old mortgage, like 20, 25 years old. And so they assumed that the mortgage was paid off. In addition, there were some city liens for like uncut grass and different things like this. The city liens were minor. The mortgage was originally about $90,000, but it was originated over 20 years ago. So what do you do in a case like that? How do you, if we were not able to buy the property with that outstanding mortgage balance on there, so we needed to get to the bottom of it. Now, since the heirs did not take out the mortgage, they did not know how to get a hold of the lender to find out what the mortgage balance was. In addition, there were delinquent property taxes, and the property would be lost to the tax buyer in another month or so. So you got city liens, you got delinquent taxes that are coming up for the last day to pay, and you got an unforeseen mortgage. So a lot of times real estate investors will just move on. But what we decided to do, because we have a little experience solving these problems, and we've done this in the past, we decided to help them figure out who the current mortgage holder was. When we contacted the mortgage holder gave a balance with all this delinquent interest that had been accumulating. And let's say it was $60,000. So we negotiated back and forth with the lender. We told them that we couldn't pay the $60,000 and the heirs could not pay the $60,000. And we sent them a copy of the last day to redeem redemption for the property taxes, which was 30 days out. So the property taxes were, let's call it $30,000. So now we informed the lender that they would have to pay the $30,000 in property taxes to save their outstanding balance on their mortgage. And after they went to their committee and reviewed it, it took a couple of weeks, they decided to give a hefty discount. They decided to lower the outstanding balance from $60,000 to just under $20,000. That meant that for us to buy this property, we had to pay off the $30,000 in taxes. We had to pay the $20,000 for the old mortgage, and then we had to give the heir some what we call walking away money, so they would sign all the paperwork and get something for going through this process. So by doing that, by negotiating the lower payoff on the mortgage, we created equity for ourselves. That deal was a lost deal. That was a dead deal. But because we took the time and we had the time to negotiate with the mortgage lender, we were able to get a discount, and that's where we made our profit, because buying the property right is when then you can sell it at a higher price and make your profit. So the moral to this lesson is to always try to negotiate with any lien holder that you can negotiate a payoff. I would say in my career of investing, 40 to 50% of these lien holders, cities, mortgage lenders, will negotiate, will accept less money, because especially if they have a deadline where they could be wiped out of everything. So in this case, it was a win-win, and I hope you can use that story in your future, like when you see a similar transaction in the future. So the important takeaway from this lesson is that it's really important to get the title information. Now, many cities around the country, many counties, have all the lien information recorded, and some are very easy to read and some are a little bit more challenging. But if you can get access to the mortgage records, which also show the mortgages and the releases, then you have an advantage. You can check real time while you're on the phone talking to a lead. You could actually be bringing these things up. Some counties don't have this, so you're going to have to rely on a title company. And those are good partners. Hopefully you have a good relationship with your title company. But imagine it's the end of the month and they're busy trying to close out all these deals, and you're trying to call them in a rush to get the answers to this question. So two things. Number one, if you have this available in your city, you should learn how to use it while you're on the phone negotiating with people. And number two, be nice and take good care of your title reps, because when they are busy and you call them and you need a favor, they will probably give you that extra service that you're going to need so you can get the bottom line information on the liens and mortgages that are on a property you're thinking about buying. Okay, last thing I want to talk about is, and I talk about this often, real estate might not be the best hedge against inflation anymore. It used to say you buy real estate because it always goes up in value. Well, it's kind of flat right now. We talked about that earlier. And I don't know how long it'll stay flat, but interest rates are high, so it's going to be flat for a minute or two. So with inflation going higher and the property's not going up, that just proves that properties do not always go up in value and outpace inflation. So what are some of the things that you should consider or think about investing in real estate versus being a hedge against inflation? Reality check. There are rising costs of debt insurance, taxes that are going to eat into your returns as a real estate investor. And these things are going to take away your potential profits, and you have to keep them in mind. They are not going down, folks. Property insurance is not going down, property taxes are not going down, and repairs and expenses are not going down. So when you're looking for good returns on investment, consider the alternatives, hedges, right? Stocks, commodities, private equity, and crypto. You should have a diversified portfolio, which includes real estate and these other assets, to make yourself well-rounded to handle the different swings that are happening in the economy. I'm not saying real estate is bad, but don't assume that it is the perfect hedge against inflation. So that's what I wanted to go over today. I'm looking for some joint venture partners. If you have any deals that you can find that have a lot of built-in equity, but you don't have the capital, give us a call, email us, call our office. We're looking for joint venture partnerships. We can put up 100% of the money, and we'll come up with an equity share with each other when we sell the property and dispose of it. If you like this video, like the button, subscribe to our channel, send us to other real estate investors who might be interested in this type of information, and I hope we do a deal together soon in the future. Have a great day.